Good morning, everybody, and welcome to the Daily Energy Markets Podcast. It is mid-May, 14th of May, which means it is the middle of the quarter. And we have Brent crude oil trading this morning in a range of fairly little change, you'd say, 83.42, up a few pennies. It's been up and down a few pennies in early Asian trade. So not much movement there, a kind of a follow on from yesterday. In a way, the market remains little changed so far this week. In essence, perhaps looking for direction. Let's kick off this morning with Ali Al-Rayami, consultant and former Director General of Marketing at the Ministry of Energy and Minerals in Oman. Ali, I start with you this morning because it seems in some ways the only sort of tangible direction this market can get at the moment is the OPEC Plus renewal, or its June 1st meeting, and the expectations that revolve around that. Your thoughts now, 2 weeks out from that meeting, is sort of the biggest one so far this year in adjusting, although there was a decision earlier in the year to extend the cuts through the second quarter. Your thoughts on what the profile looks like now for the OPEC decision and which way they're likely to go?
Thank you, Sean, and good morning to everybody. For OPEC, I think I don't want to use the word we are all confused, but when we talk about the cuts, there are two different cuts. There is voluntary cuts, and there is also the normal cuts that everybody agreed on, and it is going to continue until end of this year. That's what was agreed before, and everybody is happy, and we are all doing fine on that. But the focus now on the voluntary cuts, that is the thing that everybody is talking about. Is it going to be extended, or is it going to be gradually allow the countries to produce more? That is the dilemma that we are all in. But in reality, I think this is something that it should be taken outside of OPEC meetings, because this is a voluntary. And countries, most of these countries, they have agreed outside of the meeting. They have they came up themselves to propose that we need to do more for market to balance and also to improve the prices. So the discussion on that is going to be like a side meeting between those countries that they have agreed to cut voluntarily. I think the debate and also the lobbying on that is already started. I think His Royal Highness the Prince Abdulaziz, I think he will not wait until the last minute to decide either we are going to continue or we are going to do something else. Especially that we have already seen negotiations tools are being used by some ministers, like the Iraqi minister who already announced that we will not agree to either to extend or to increase and so on, and then next day he changed his statement. But that is a tactics that always ministers and also some countries using before they go into this kind of discussions. But I think it is going to be agreed before the meeting. And also in my opinion, I think I still believe that we need to extend, I don't know, maybe for another 3 months or maybe to the end of the year, similar to the original ones. So that is what I think it is going to happen in this June meeting. But that June meeting by itself, I don't think it's going to be any kind of long discussions, rather than just review the normal market conditions and
So you expect that the voluntary cuts, as you call it, will not be part of the June 1st meeting? That will be something either dealt with before or after?
It could be in the agenda, but I think the agreement will be before the meetings.
Before, in order to diffuse, I suppose, and
absolutely
allow the, Michelle Weiss Bachmann, Principal Analyst at Lloyd's List Intelligence. Michelle, I wanted to get your thoughts on, we're dealing with OPEC Plus there, with Ali, and the idea that they may or may not add new supply for the second half of the year. The other part of this equation, of course, is Russia's crude oil exports continue to get to the market. Tankers seem to be still defying regulators. Is there anything on your horizon that says that there might be that finally the sanctions might curtail the Russians' exports? Because there has been some moves to make it more difficult for shippers.
Good morning, Sean. From where I stand right now, I think there's a lot of energy and a lot of hot air, but very little substantive action. Shipping continues to get out of Russia. About half of it is on what we call a dark or parallel fleet of tankers that operate outside Western regulation. That was for the full month looking at April. And those tankers are going further outside regulators. I'm looking at some that have gone and reflagged to Eswatini, which is a false flag. And there's all sorts of shenanigans happening in order to keep Russian, Iranian, and also Venezuelan oil flowing. And I think regulators are weighing up what to do, but at this stage, they haven't really wielded a big stick. And I think, once again, they don't want to cause a price shock in an election year for the US.
How does a ship with a false flag dock at a port or get insurance?
That's a very good question. The tankers that I'm looking at are in international waters and taking on ship-to-ship transfers, so that operate outside Western jurisdiction. We're watching them very, very closely. There are 5 at the moment. They have been operating in Russian trade. They were US sanctioned, but still they're sailing, and also they're engaging in deceptive shipping practices like spoofing their location. One we've been watching that recently picked up a cargo of Iranian oil. It's now in Anchorage off Khor Fakkan, for example. I watch this every day, and the levels that traders are going to make sure that oil continues flowing is quite extraordinary from a regulatory perspective.
Russell Robertson, Chief Commercial Officer at the Dubai Mercantile Exchange, based in Singapore. Russell, looking at the sort of trajectory as we go into the big sort of next moment, if you like, on the calendar, mentioned earlier, the OPEC Plus meeting, they will be reading the tea leaves, as we all are, trying to understand the trajectory of the market this year. We saw in the first quarter plus $5 each month, January, February, and March, a pretty steady climb from $75 to $90 and something. And then in the last 6 weeks, second quarter, it's been a steady step downward back to the low 80s. Your thoughts on why we've come off so strongly from that sort of peak 90 plus, and are we now settled in our happy spot in the low 80s?
Morning, Sean. I think coming through some seasonal changes at the moment, which naturally put prices a bit lower, refinery maintenance, etc., is just about to start coming back online. We've obviously had some risk off as well, probably with some of the geopolitics in the region. It seems that some of the moves recently have probably taken out some funds out of their long positions, which has probably helped push us down a bit. But just from a personal opinion, it still feels like we're very range bound at the moment. You've still got a lot of demand coming in from China for the physical barrel, for sure. Certainly east of Suez as a general. We've got new refining coming online this year, some big ones too, such as Yulong is a good example, 400,000 barrels a day. So I think that with OPEC probably likely, as Ali said, to stay on a steady course, the fundamentals are not really changing too much. The supply and demand is pretty stable. Nothing new coming to the market. It seems to be moving more into a macro look now. See what CPI does this week and how that's going to affect inflation, and see how much it's going to hurt the doves, I guess. But if you look at the market, it's very, very range bound, really.
If you just pick up on the point you made there about the funds, the sort of investors, if you like, who come into the market and see opportunity, a lot of that seemed to arrive in the first quarter, non-physical, but more paper traders. Obviously, you would see a lot more of that on the exchanges such as yours. What does that look like now and the outlook for, are they gone for the year? They come back? Your thoughts on that as as a part of the sort of elevating factor here, more money coming into the market?
There's not really a straight answer because all of the clients have very individual strategies. So I'd be very surprised if they were gone for the year. They will just wait for the next move and they'll come back and reposition. It just depends on the type of client. Anything from a commercial firm who naturally hedging their term contracts to more the financial traders who are looking at arbitrage between all the different spreads. We've got a lot of grade changes at the moment. The sweet sour spread's been moving plus and negative for the last few months. So there are plenty of opportunities and reasons for people to come into the market now compared to maybe 2 years ago. So it's made there a lot more opportunity for every different type of strategy to take advantage of the Middle East oil market particularly.
Ali, the sort of retreat from $90+ if in the first quarter as we went through 3 months of consistent steady increases, and the come off from that nearly $10 back would appear to be the sort of diluting of the geopolitical risk premium that might have come into the market given all the dramas in the neighborhood. Your thoughts on that risk now dissipated? Is it gone away? Iran, Israel love each other now. The conflict in Gaza is no longer. The Houthis have gone back to the mountains, chew some cotton. I mean, where is the stress, or is the geopolitical stress? Are we a bit asleep to that? Your thoughts?
I think, what made the price before to go to 93, it was because of the Iran-Israelis conflicts. And once that disappeared, then the prices automatically corrected itself and the market corrected itself. And then it went to the position that it should be. I mean, the 83, 84, or up to 85. I think this is the range that without the premium, the geopolitical premium is supposed to be. So I think the 83, 82, this is the range that we should be on. I don't think that the geopolitical risks are gone completely. We are still believe that there are some tensions here and there. The Red Sea tension is still there. The Gaza problem is very hot these days. It started again from yesterday and day before yesterday. So the Hezbollah also, they are starting to attack more. So the risks are there, but the market is not responding to that because it is a bit far from the producing countries, and also it didn't affect any supply to the oil market so far. Nevertheless, the situation or the problems between Ukraine and Russia, there's still some drones have been thrown here and there. So the political position and the political issues are still there, but maybe the one was creating more focus it is gone for the moment. That's why we see that the price is on this level at the moment.
Michelle, just picking up on that, one of the things that came out of the events in April when Iran and Israel were facing off and we were kind of on a cliff edge was the backside of that was increased rhetoric around the possibility that the US would start to tighten its existing sanctions on Iran, which it had kind of been turning a blind eye to in terms of Iran's oil exports, which of course sort of basically came back to as much as they can every last year. Are you seeing anything in the shipping that indicate that those I mean, the US also didn't renew the Venezuelan exemption after 6 months, although there seems to be a lot of fudging around that as well. But in particular to the Iran getting its oil to the market, getting its tankers to China and so forth, is there anything there to indicate that the Americans and others are tightening this grip?
Well, they're taking action. I have seen some companies sanctioned, but I haven't seen flows diminish in any respect. It's just a completely parallel market now. What I am doing is I'm looking at physical indicators within the shipping market to see whether or not those fundamentals give any guidance to oil demand in the next 3 or 4 months. And the only I'm looking at ton-mile demand, for example, which looks at it's a proxy of tanker demand. It looks at distance. It looks at the volumes carried by distance traveled, and ton-mile demand for tankers was at records last quarter. It has diminished now, but we're seeing that there's still a great deal of strength in the tanker market, even though when you're looking, say, for example, at diesel demand in Europe, the futures market is in contango, which suggests that, that situation bears watching in case that is an indicator of what's going to be happening over the summer. But in terms of shipping signals on Iran, there's very little indication that any sanctions enforcement is having any real actual action on the physical shipment of that crude to China.
And given that shipping operators, I mean, there was some talk in the first quarter that the number of ships that were availing or participating in the so-called dark fleet had diminished quite dramatically over the few months of the end of last year into this year because of the threats of US sanctions. Are you saying that that now has eased off again and there's still lots of ships participating in that opportunity for the returns and the lack of consequence?
Absolutely. By my calculations and by our methodology, about 11 to 12% of the internationally trading tanker fleet is involved in those three sanctioned trades, US sanctioned trades of Venezuela, Iran, and Russia. And that 11% figure has remained, I think it's about 600 tankers now. It's grown by about 50 tankers in the last 4 or 5 months. So it's still quite a present reality that
600 tankers participating in what is called the dark fleet.
Yes, that's correct. It's something that I think is well known in shipping circles, but not so much outside in oil trading circles. I think on the physical side, there are a lot of traders who spend enormous amounts of money on compliance to make sure that they don't inadvertently undergo a ship-to-ship transfer with a tanker that has been engaged in these trades or perhaps has connections to the sanctioned entities. But it's a real and growing phenomena that everybody is worrying about at the moment. Those numbers are quite confronting.
Russell, just picking up on that, I mean, we're now 2 years into these sanctions from the Russia. Obviously, Iran's been around a while, Venezuela with the current coming and going, if you like. What are we seeing any legacy given that scale, as Michelle has just outlined? Is there any distortion in price discovery? Are we seeing any reflection or any legacy for the obviously Dubai Mercantile Exchange manages the Oman contract, and there are many others east of Suez contracts. What is the legacy impact to the oil pricing from this scale of sort of dark fleet trading?
Yeah, those numbers are quite significant, clearly. That was a new statistic to me, so very interesting to hear that. I think for our market, particularly in the Middle East and Oman, we have obviously not really impacted in that side of things, but the freight costs have clearly gone up a lot, and that does impact my end user completely. Again, the Red Sea as well is not really impacting Oman because east of Suez doesn't go that way. So I don't see any particular legacy issues related to Middle East crude, but I do think that it's probably priced in somewhere that there is that additional liquidity, if you like, an additional barrel out there. And if that was to go away, I think you probably would see prices go up just on the basis of supply and demand. And I just wanted to quickly iterate what Ali said, actually, because that 83 to 85 number is very significant. And if you look at even last year, we saw very technical moves around that. Triple tops, double bottoms, resistance, support lines throughout the entire year last year. And that's moved into this year too. So it's a very interesting number to watch as the market moves around.
Let's go to our survey question, which kind of sort of perfect segue. Brent has returned to low 80s. Is that a floor or ceiling for oil markets, current oil markets? Brent has returned to the low 80s. Is that a floor or a ceiling for oil markets? The we've seen that from the beginning of the year, we started at $75 a barrel, went up to 90 plus, but on the average price, we are in the low 80s for year to date. So floor or ceiling, welcome the thoughts of everybody, and we take that out. Ali, I wanted to give it the outlook for individual producers and the countries. Obviously, Oman, Saudi Arabia, even, and obviously a much bigger actor, has pulled back on a number of its major projects, given some of the economic challenges of financing. But Oman, just some good news. Its debt is sort of moving in the right direction. Its credit rating has gone, has recovered in recent times. Generally, for the macro picture, and obviously all these countries, we've got Abu Dhabi and UAE now increasing capacity quite significantly and looking to deploy that. Where is the sort of fiscal pressures for the OPEC plus members of this neighborhood to seek a higher level than we currently have, and that they're taking this low 80s average for the year? There was talk that Saudi and its partners wanted a 90 plus price, not an 80 plus price. Your thoughts on where that, given the fiscal requirements of this neighborhood, where their sort of muscle will be used to sort of maintain the price?
As a producer and also as a GCC member, I need to be very careful when I talk about the right number, because it varies between the countries. For Oman, maybe 83, 85 is a good price, for oil. But for Saudi Arabia, they need more because they have their expenditures and also their programs and also investment that they went through. Maybe they need more. But in totality, I think anything above 80, it is good for producers and also for the consumers. I think more than that, 95, 100, it is not sustainable, and it is not really good for the market and also for the world economy. So I think to be in this level, 80 to 85, it is better for everybody. Although that maybe it is not good for some countries, but in totality and also in terms of the world economy, I think this is the right number. For Oman, I think we, as you remember, in 2015 and 2016, the prices went to below 20, and we had to borrow a lot of money to sustain the budget and also to sustain the projects and also to maintain the growth of our economy. So we rightly or wrongly, but that's what happened, and we had to borrow billions of dollars, and now we are in a situation where we have to pay back, and our rate went down from these three agencies. But I think the policy now started from 2 years ago that to maintain paying the debts and to reduce the debts in totality. I think it is a good strategy, but to me, I think it is also it had to be in balance with the local economy. We don't want to see the economy and the countries and the companies, that they are suffering and there is no enough projects for them to have growth. We all in Oman here depends on government projects. So when there is no enough government projects to support the economy, to support employment, then I think it is something that it is going to affect us directly. So I think the balance between paying the debts, which is something good, but also to keep some for the local companies and also local growth, it is wise to think about.
Let's, Michelle, I wanted to get your thoughts today, sort of a run around the world, so to speak, on the choke points. Were a big part of the narrative in the first quarter, both particularly the Red Sea, but also the Panama Canal was suffering from drought. We had threats to the export channels out of Russia and the Baltics area, and we also have increasing noise and stress around the South China Sea and the Straits of Malacca. So I wanted to get a around the world sort of view there on what those choke points look like at the moment and their outlook.
Certainly. So with the Red Sea, we're looking at traffic down about 60%. And I think for the week and about a week ago, Suez Canal transits were at the lowest level since the Houthi trouble began. So 60% down with the Red Sea. Tankers are still rerouting around there. I think with the Danish Straits, there's been, again, a lot of hot air, but those vessels, those tankers have what we call in maritime conventions the right of innocent passage. So there will be no interruptions there. Strait of Hormuz, I know we've talked about once again. I think the possibility that the threats of closure are remote. And when it comes to other areas, I believe that barring any unforeseen geopolitical events or economic shocks, well, everything is fine. Panama Canal is down about 20%. We've actually seen transits increase. So on a choke point level, fingers crossed so far, it's just steady as she goes. No big changes expected, barring, of course, with the Red Sea. If there's some sort of resolution in Gaza, then I think transits will resume through the Suez Canal.
Russell, last word to you as we get the survey result on the screen, which is floor. So it's a bullish room rather than a bearish room. I wanted to get your views, Russell. Again, a slightly wider subject, as was the choke points to Michelle, but to you, we have just come through the first year anniversary of WTI Midland included inside dated Brent, which is, of course, the sort of world's biggest benchmark, or whatever the suitable adverb might be there. And I know that's obviously not a DME contract, but a DME benchmark. But nonetheless, I wanted to get your view. Obviously, it's a huge change to the overall market, and how it has gone, how it's impacted other benchmarks, other pricing. Your thoughts in general, as it's the first anniversary from your perspective.
Yeah, it's very interesting. So WTI is clearly setting the price of Brent on a more regular basis. Last time I looked, it was around 60 to 70% of the spot is done on a WTI basis. But if you look at Laycan days, a few ahead, it was up to 87% recently. So it clearly is a key figure. However, when you translate that into trading volumes, for example, or pricing, the spread between the two contracts hasn't moved too much. It's not like they've converged into...
The spread between which contracts,
Sorry, Brent and WTI. It's still trading around $5 differential. But what we are seeing is that spread has become much less volatile. So the spread between the two contracts is reduced the volatility, allowing more people to take part. But I think what a lot of people were expecting were to see the spread between those two contracts start to narrow. So that hasn't happened. However, volumes in total, if you look at Middle East contracts related, so Dubai, Brent, Oman, Murban, things like that, is up around 10% as a total year on year. If you look at more the regional contracts, some of those are up 70 to 80%. And I think a lot of that is related to that ability to be able to trade that spread. It still does suffer from difficulty regionally. So in Singapore, for example, you don't find many people having the ability to trade WTI just in a corporate hierarchy sense. So you still have the Brent in Asia, WTI in the US, and there's still a lot that need to be done for those trading entities to change their behavior and to take advantage of that price correlation.
Well, we're going to have to leave it there as we wrap up our session this morning. We have Brent crude oil trading, as we said at the beginning, a little change. It's sort of in the doldrums, you might say, in terms of lacking any. I mean, obviously, it came back quite aggressively from 90 plus over the last 5 or 6 weeks, and on occasion some big weekly drops. But it seems to have found some kind of a comfort settling point here in the 83 to 84 window. Will that be a hold and be a floor, as we're told by our survey result in this room, and it goes back up again, or is that the ceiling and it doesn't have that momentum north? We'll have to wait and see. Michelle, thank you so much. As always, really great to get your insights. Michelle Bachmann sitting in London, Russell Robertson with the Dubai Mercantile Exchange in Singapore, and Ali Al-Rayami, as always, great to get your insights from Oman on the region and on the markets. No one better than they. Thank you so much. Have a great day, everybody. Catch up every morning at 10:30 UAE time. All the best.
Thank you.
Thank you.
Thank you.
All the best.
Bye-bye.